Are you worried about the AI froth?
So, there's something, by the way, this is a time of year you tend to get momentum gets chased out of the markets, particularly today where you have ambiguity around some trends that are taking place. So, by the way, I don't think it's an AI bubble, and I don't think there's too much froth. And depending on where you go, if you look at some of the big hyperscalers that trade at 20 to 25, 26 times earnings, and they throw off ROE, return on equity of 30, 35, 40%, and you look at their free cash flow. I've never seen in my career free cash flow generation. We can talk about top line revenue growth. When you can have that much free cash flow generation, it allows you to do your CapEx, which is extraordinary today, build R&D, which is your future cash flow, and then you can buy back your stock. So what's happening, you have an unbelievable dynamic, and by the way, we're now about to open the buyback window, that you have this dynamic that you throw off immense amounts of free cash flow. And so there's multiples are not scary. There are parts, I see it in the private market and I see it in some places where you're seeing businesses that have no cash flow for a number of years. How much would you finance those? So I do see froth in some areas, but in the traditional big market cap stuff, and I would say related to that in semis, in healthcare technology, where you're seeing rapid change, but real cash flow alongside of it, it is the exact dichotomy.
Rick,
of what you saw in 2002.
Why then do you have these large cap giants tapping the bond market to the degree they are, and not just the broadly syndicate market, but also raising capital off balance sheet too? If they were so confident and have such robust cash flows, is that not a concerning turn of events that they're instead building up on debt piles?
So first of all, when you look at any measure, debt to EBITDA, you look at their debt to book cap, debt to market cap, these companies are under-geared or under-levered. Their cap structure is so low in terms of leverage certainly relative to their market cap, but relative to their book cap. If you were running a big, mature company, you think about what does your normal cap structure look like, and if you're going to fund near-term CapEx over the next couple of years, if you can do it out the yields curve, which is where you see a lot of that financing take place, to say, gosh, I am throwing off a lot of cash flow, but if I can lock in these rates, and if I'm as a shareholder of any of these companies, I say, why in the world would you fund everything with equity? Or why wouldn't we put a little bit of debt, get a little bit of gearing, get your ROE higher? So I just think it's a natural evolution of, gosh, this is how you run a big company, and this is what a normal cap structure looks like.